If you are planning to leave a traditional IRA or 401k worth $1 million or more to your adult children, there is a hidden tax trap in IRS regulations that's ready to confiscate 40% or more of this inheritance in tax payments. Today, I'm going to show you the exact required distribution rules, why they target your adult children while they're in their highest earning income years, and how you can diffuse this tax bomb using advanced strategies like Roth conversions and qualified charitable distributions. For decades and decades, retirement planning was simple. What you wanted to do was save as much money as you could in a pre-tax retirement account like your IRA and 401k, let it grow over your life, and then leave it to your kids. Once they inherited it, they could slowly take distributions over their lifetime, spreading out the tax hit. It was arguably a really great wealth building strategy. But the IRS noticed how much money they're leaving on the table, so of course, they decided to end this and take their money back, or rather our money back. If your estate plan relies on laws written 5 or 10 years ago, then what you're doing is you're effectively putting the IRS as a co-beneficiary on all of your accounts. Make sure you stay till the end of this video because we're walking through tax diffusing strategies like the Roth conversions and the qualified charitable distributions that are designed to actually drain your current pre-tax accounts, limit taxes across your lifetime, and then leave your kids a tax-efficient inheritance. To grasp why these changes are so damaging to the average American family, we have to understand how the rules changed and what they used to look like compared to how they are now. So under the old rules, if you were to leave $1 million account to your son, a pre-tax retirement account, your son would be required to take small distributions for the rest of his life on that account. And with that, he would have smaller tax payments, probably not pushing him into higher tax brackets. He could use it as a supplement to his current income or to his retirement plan. Today, for all non-spouse beneficiaries, the idea of stretching the account over your lifetime is totally dead. It's not allowed at all. Under today's laws, the account must be totally empty following the 10th year of the account owner's death. This is also why it's important to understand the difference between Roth IRAs and traditional IRAs because they have vastly different tax impacts on your children who inherit these accounts. If your child inherits a Roth IRA, the 10-year rule still applies. They still have to empty that account in 10 years. However, the big difference is you already paid the tax on the contributions. And because of that, any distribution they take is 100% tax-free. They owe no taxes at all. But unfortunately, if you're like most successful retirees, your biggest asset is not a Roth IRA. It's a traditional IRA or a traditional 401k. And you got a tax deduction when you made contributions, meaning all distributions, whether from you or for your child in the future, are all going to be 100% taxable. These are at ordinary income tax rates, not the preferential long-term capital gains rates, and they're stacked on top of all of the income that your child is already earning. When the 10-year rule was first introduced, everybody assumed that there was going to be complete flexibility in how and when contributions could be made. So theoretically, you could let your account grow for 9 years and then take all of the distributions out in year 10, following the rule that the account would be empty by the end of the 10 years. And everybody thought that this would be acceptable. However, in usual fashion, the IRS did not quite agree with this and later issued final regulation that this was not going to be the case, that there were going to be extra rules added. And this can be a little bit complex. So how it works is that the 10-year rule will change depending on whether the original owner was subject to required minimum distributions or not. There are 2 sets of scenarios that we have to walk through with different rules. So first is scenario A, and this is when the owner died before the required beginning date. And this is the date where they would have had to start their required minimum distributions. So in this scenario, there is total flexibility, how we discussed. So the beneficiary, the adult child, they could actually not take any distributions in the first 9 years and then empty the account by year 10. So very flexible. Now scenario B is a little bit more complicated. So in this scenario, the original owner dies after the required beginning date, so they're already subject to required minimum distributions. In this case, the IRS says, well, you already started doing those minimum distributions, so now the beneficiary has to continue those as well. So in years 1 through 9, they're also required to take a RMD, a required minimum distribution, and then still, of course, have the account empty by year 10. So a little bit more complex. Now, a bit of a warning here. If your beneficiary is not properly taking those RMDs, they can face a penalty from the IRS of up to 25%. This is very punitive. You can probably already see, but leaving traditional accounts to beneficiaries can often result in a very large sum actually going to the IRS rather than your own family. And on top of all of this, the income often comes at the worst possible time for your kid. Because think of the natural timeline of a family. You're probably going to be passing away in your 80s, and at this time your kid is likely in their 40s, 50s, or 60s. This is also their peak earning years, so they're already at the highest marginal tax brackets that they're going to be in their life. So let's run some numbers on a realistic case study using the current federal tax brackets. So let's say that you leave $1 million to your daughter. She's 52, she's married, and together her and her husband, they make about $150,000 per year. So they're comfortably sitting in the 22% federal tax bracket. So she inherits the $1 million IRA and decides that she's going to make equal distributions for all 10 years to minimize the tax impact. So that's $100,000 per year that's getting added to her tax return. On top of that though, each year her income in general is probably going to be increasing, and possibly this distribution will have to be increasing as well each year. But even with this same example, her income turns into $250,000. Now all of a sudden, she has gone past the 22% bracket into the next bracket, and over the next 10 years, this may have to increase as well. She already took a big tax hit. But now let's say that she was subject to the flexible rules, and she decided to not be proactive and to leave all the money into the account until year 10, where she has to take out all of it. Now she has to add at least $1 million to her taxes, to her tax return as income, and all of a sudden, she's in the top marginal federal tax bracket. It's very easy to assume that she could be paying almost half of that money to the IRS. So half of your legacy just disappeared, and it went straight to the federal government. But how can we actually stop this? Let's transition to some of the defensive strategies that you can take to defuse this tax bomb. Now this brings us to the core strategies that I promised to share with you. And here are the 3 strategies that we most frequently use with our own clients. So the first strategy is systematic Roth conversions. We already know that your child is likely at their highest earning years, they're in their highest tax bracket, so instead of forcing them to pay the tax, you can pay the tax yourself. You're retired, you're likely not making very much income, only from your Social Security, maybe you have a pension and retirement withdrawals, so you may be in a lower tax bracket yourself. So you can convert the dollars from your traditional IRA into your Roth IRA and pay all the tax on those dollars yourself. This leaves your child a clean Roth IRA. It's very tax efficient. They still do have to empty the account in 10 years, but any withdrawal they take, 100% tax-free. It will not affect their taxes. Now strategy 2 is the tax bracket leveling strategy, and it can involve the Roth conversions as well. So what we do is we compare your current tax rate compared to your their expected future tax rate, that tax bracket. So if we expect that they'll be in the 32% tax bracket, we'd be doing Roth conversions or IRA withdrawals until their income is in the 24% tax bracket. Anything that's less is ideal in this case. Now strategy 3 is the lifetime qualified charitable distribution or QCD strategy. If you're a charitable person, if you want to leave money to charities, to nonprofits, then you should not be giving cash if you have a large IRA. You want to be giving out of your IRA to the charity. You do have to be over 70 and a half to do this, but you can give up to $111,000 to the charity out of your IRA, and it can actually count as your required minimum distribution. So what you're doing is you're decreasing your balance of your IRA and leaving your cash alone, That way, when you do pass away, you can leave the cash to your kids, they won't pay taxes on it, and they'll have a much smaller IRA to take care of a much smaller tax hit. The biggest takeaway I want you to take from this video is that you either have a plan or you plan to pay more in taxes. If you need help creating a strategy to leave a tax-efficient legacy to your children, please click the link in our description and we can have an introductory call and see if we may be a good fit for each other. But I hope you liked this video and keep a lookout for more videos in the future. Thank you.